market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, U.S. President Donald Trump has expressed confidence in the U.S. military campaign against Iran, even as the duration of military operations remains uncertain. Now, Tehran has again targeted Israel and Gulf states, while Iran has denied that it has closed the Strait of Hormuz. Well, Bloomberg's Jumana Bersetchi is in Dubai. Jumana, President Trump says the U.S. is doing very well. What's the latest?
Yeah, well, we're entering to day six of this war, Francine. And yesterday, President Trump described it as going very well, that the operations are going very well. Later on, we heard from the White House Press Secretary Caroline Leavitt, who also said that right now the U.S. has complete dominance over the skies in Iran. A Central Command saying that they've hit over 2,000 targets in Iran since the beginning of this war, spread out over 150 cities. And the operations, the joint U.S.-Israeli operations, are ongoing. And so in terms of, one of the big questions that people are asking here is how long this is going to go on for. We also heard from the Defense Secretary Pete Hegseth yesterday, and he suggested once again that this could really go on for weeks. Didn't give an exact time frame, but he said weeks. He did not say days. And one of the other significant developments yesterday afternoon is that the U.S. actually shot down and brought down an Iranian warship that was sailing near the coast of Sei Lanka, so far away from the Persian Gulf. And this is significant because it's the first time since World War II that a U.S. submarine has brought down a surface vessel. And in retaliation to that, we've heard from the Iranian foreign minister this morning, who said that the U.S. will come to bitterly regret the precedent it has set. And what we're seeing is another front opening up, especially around the seas here. And coming back to the objectives that President Trump has described, he's talked about eliminating Iranian missile capabilities, their nuclear capabilities, but also the Navy. And we're beginning to see that play out at seas. The other objective, of course, being that they want to stop Iran from sponsoring, quote unquote, terrorism around the region. So very much still in the phase of an expanding war.
Jumana, what's the situation in the Strait of Hormuz after Iran denied the waterway was closed?
Yeah, so this morning we had more comments coming through from the Revolutionary Guard, RRGC, saying that they still can maintain control over the Strait of Hormuz, even though they haven't, quote, shut it. But as we've been reporting, Francine, it is effectively shut, and vessels are choosing not to pass through the strait because of security concerns, because of mounting insurance costs, shipping costs. They are choosing to stay away. We had that announcement out of the U.S. administration yesterday suggesting that they are open to providing naval escorts. It hasn't really made an impact to this market because there are lots of questions about implementation and, of course, take-up. But it's not just the straits that people are focused on. There are still ongoing strikes occurring at some of these key energy infrastructure sites in the region. Yesterday in the afternoon, the Ras Tanura refinery, the largest refinery in the Middle East, and that is in Saudi Arabia, was once again targeted. It didn't cause damage yesterday, but we're still talking about production disruption. The Qatar LNG facility still signaling halted production, and with some sources suggesting that it could be closed for a couple of weeks. And you're seeing the ongoing global ramifications here of these much higher energy prices and concerns that this isn't just going to have a regional impact, but a global impact. And the calculus from Iran here is that they will level so much damage economically on some of these Gulf states that the Gulf states may have to use their own political capital with President Trump to bring about some end to the war. But that has not happened.
Jumana, thank you so much. Bloomberg's Jumana Bersetchi there in Dubai. Now let's also bring Magdalena Polan, head of EM Macroeconomic Research at PGIM, and Trevor Williams, co-founder and economist at FXGuard. So thank you both for joining us. Magdalena, I mean, a lot of everything I imagine you're seeing in bond prices will depend on what happens with the Middle East and, of course, a risk-off or risk-on mood and what happens with the price of oil. What are the dynamics at play that make you, have an informed decision, actually, about what happens next?
Well, we are trying to price in so many different scenarios of unknown probabilities and outcomes. So it's quite a challenge for financial markets to price these very fat tail risks. And what we have seen so far is that the market reaction in the energy prices, commodities, as mentioned by a colleague, obviously has been much more pronounced. But in the dollar and other asset prices, it's still more muted because I don't think we are yet pricing a new macro regime. And in dollar, for now, we're seeing more of a technical and positioning-driven repricing, while in the other markets, it's really mostly about inflation and what it may mean for either central bank actions, local bonds, and then in the future growth.
Trevor, again, how do you see this playing out? We have a number of Bloomberg Economics analysis saying, look, the price of aluminium can go up quite significantly, a lot of the commodities can go up, and then I guess all bets are off for growth of the world economy.
Yes, I think absolutely. I totally agree with the things Magdalena said, but on top of that, I think that the scenarios are looking even grimmer. More damage to the surrounding economies, to the growth path, which will feed into weaker global growth, of course. And also the escalatory risk is still there as well. There's still a potential that Iran starts to strike, for instance, water infrastructure, which would cause greater economic damage. But absolutely, I think that the effects of this on commodity prices more generally will widen if the conflict continues.
Magdalena, what does it mean for markets overall?
Prolonged uncertainty. Prolonged search for the new price level, for the new macro regime, and then probably also thinking about the longer term and where the rates may end up longer term. So not just pricing the Fed decisions or just pricing inflation, but like how do we even price assets in this world that is so much more uncertain, that requires so much more planning, redundancy, uncertainty, breakage of supply chains. So that can be the new regime that we're pricing in, as opposed to just the macro regime for the next year or two.
I mean, are emerging markets impacted disproportionately because of some of their dependence on oil?
Well, they could, but I think oil prices are global, and gas and oil prices are global, and everybody is affected, especially if you're buying. So, especially when it comes to the Gulf production, Strait of Hormuz, who's buying that? Well, Europe does buy gas from Qatar, which is now cut off, but it's not the key supplier, right? There are other suppliers. Asia buys a lot, and that also means Japan, South Korea, obviously China. So these are both emerging and developed markets. Some of them have high supplies or high storage, so they can be safe. Where I think EM can be affected more is the fact that simply energy matters more for consumer inflation. These countries are smaller, they have smaller markets, and then the risk on regime does still matter. And then we're going to be back to this old playbook where reserves matter, buffers matter, policy credibility matters. So the standard global EM risk-off playbook.
But Trevor, of course, for all of these economies, you also have the underlying of AI. So does it change again? Does it change fundamentally how you look at the economies, how you price productivity, how you price also energy demand?
Well, I think that the fundamentals of how you look at an economy remain the same. This is just an added additional volatility factor, which has to be taken into account. I don't think it will impact the take-up of AI. I think it will be used in helping to strategize and plan how you smooth out the cycle now, given the risks that it entails. I think the bigger risk that comes partly from all of this, Francine, is that we may have a ratcheting higher of global inflation. And we're beginning to see some of that. We've not yet seen any monetary policy response, but if the conflict continues, then there will have to be either a cessation of cuts in interest rates or a reversal of some of the cuts that have already taken place, and that will slow economic growth. And to that extent, I think they'll then play into financial markets and what happens to views about bond yields and so on and so forth. So at the moment, yields have spiked higher on inflation fears, but that might be tempered if growth starts to slow, if interest rates go up and so forth. So I think that we're in for a period of more volatility.
Trevor, are we still importing deflation from China, or does the oil equation change everything? And again, when do we really need to start worrying about inflation? Because yesterday we had a couple of investors say, the market market is worrying about it, but it feels a little bit too soon.
Yeah, I don't think we're going to see any deflation anytime soon. I think it's far too early.
Not even from China?
Not even. China's particular circumstance is one unique to it. It now has an aging population. Its long-term trend growth is no longer 7% per annum. It's perhaps not even longer 5% per annum. It's more like 3% per annum. And for it, significantly slower growth lies ahead. But those are specific Chinese challenges, not a global challenge. I don't think we'll face global deflation pressure. I think, as I said, it's a China-specific effect. They will have to accept slower growth.
How do you see that, a lot of inflation forecast developing?
Well, I just would add that China has been exporting deflation for a couple of years now. And in the end, it's the underlying dynamics in the countries that really matter, because that's just a little bit that China adds on. But yeah, energy prices do matter quite a lot in the end, but they feed in slowly, right? And also, we would need to see probably a larger, more prolonged shock, because oil prices are now where they were, say, a year ago. So the size of the jump is not yet as high. And we need to remember that this also depends on policy response. So energy prices are mostly regulated, not oil and fuel, but, say, gas and heating and so on. So that depends really on what the policymakers decide to do and whether they want to absorb it. And in the end, it probably ends up being a combination of price increases, monetary policy response to some sense, and then fiscal response. But that then depends whether you actually have that fiscal space and money for subsidies, or you have to make some really difficult fiscal trade-offs, especially in Europe, where also defense needs are really looming.
Magdalena, what are you expecting in terms of the China growth dynamics? Again, just with taking out some Venezuelan oil and now with Iran, I don't know whether the U.S. is intentionally punishing China, but certainly it's a pretty big second-round effect.
It could be a second-round effect. I mean, China does have some storage, and especially of gas, there is a lot. And I think Chinese policy decisions are mostly driven by Chinese circumstances. So the recent decision to downgrade the growth target is a realistic step that reflects exactly the realities and capabilities of a Chinese economy in the environment of prolonged asset bubble deflation. And I think the message is today that they're going to let the property overhang work through, I mean, implicit message, work through for a couple of years reflects that. And also that very moderate fiscal tightening, it's not really fiscal tightening, but it's more realistic. And I think in the end, China does what China wants to do, driven by domestic policy. The rest is more of the environment in which it operates.
Trevor, what's your take on Europe? We saw LNG prices go up by 34% yesterday. I mean, this is probably one of the regions that could suffer the most, apart from the Middle East and the Gulf states.
Yeah, I totally agree. I think that Europe's already slow growing, and this will make it grow even more slowly. I think that the increase in energy prices is going to impose greater costs on industry and on households at a time when they're already struggling. Remember, the lagged effects of the earlier increases that we saw in prices as a result of Russia's invasion of Ukraine. So given that is starting to end and inflation is coming off, this may reverse some of that inflation fall and lead to slower reductions in interest rates or reversal of some of that, which will mean lower European growth. And as I said, they're already struggling with what is already really weak growth rates if one compares it with other parts of the world, including the US.
Yeah, I mean, LNG is going to be a problem for many countries.
Absolutely. So it's not as bad as what Europe faced in 2022 after the invasion of Ukraine. It's a little bit more similar like that in Asia, right, which is now facing this big shortage of energy. So having this storage capabilities helps. But for Europe, it's this additional thing that hits the European economy and the need to diversify energy sources even more. And I think also the moment for thought for the European policymakers, how much you're willing to maybe go back to face Russia as a supplier, that's a very difficult political decision.
Okay, thank you both for joining us. Magdalena Polan, head of EM Macroeconomic Research at PGIM, and Trevor Williams, co-founder and economist at FXGuard. Now, coming up, Campari Group beats estimates in its latest results. We'll be speaking with Chief Executive Simon Hunt. He's coming up next, and this is Bloomberg. Well, Campari has topped estimates in the fourth quarter, with one analyst highlighting impressive top-line growth at the Italian Spirits Group. Now, we're joined by Simon Hunt, Chief Executive Officer of Campari Group, in one of his first interviews for TV since taking the helm in January last year. So, Simon, thank you so much for joining us. When you look at the results, they're pretty good. How fragile actually is consumer sentiment right now? Everything that we've seen because of tariffs, geopolitics, and now this new war in the Middle East.
Yeah, I think what we're really seeing is some strength in our business, where consumers, where they are feeling a bit of pressure economically, they're looking for value, they're looking for brands that really resonate with them. And as a result, to come through 2025 with outperforming the industry, strong top-line growth, we've got good margin enhancement and good profit growth. I'm delighted with the performance.
I mean, overall, there's a decline in alcohol consumption. So does it make you innovate in terms of products, in being alcohol light or even non-alcoholic drinks?
I think it's important to remember in the alcohol industry is that, moderation is not a new theme. This has been running for 100 years. And the less but better story has been very consistent for many of the companies. In our case, I think what we've seen is a shift in consumer trends where people are going a little bit earlier in the day. They're also looking for lower ABV, more refreshment. They want aspirational drinks that are also accessible. And look, with an Italian background, that's exactly the space we play in. And so we've got a portfolio of brands that meets that emerging trend in a really efficient way. And the team's done a great job of activating that last year, despite the tricky environment.
I know, Simon, that you're really trying to focus on the U.S., where you're also hoping to get market share for Aperol Spritz as a valid substitute to beer. How's that going?
Yeah, at this stage, our focus has been in the strategic on-premise bars and restaurants, which is really where brands are built. And I'm delighted we delivered a plus 15% growth rate on Aperol in that environment. And then we took it into retail in the control states, trending up at plus 10, and then also into many of the open states as well. So we've got a good start in 2025. What I announced last night is that we've also hired 21 brand activators to get out, knock on doors, get into bars and really activate Aperol in the 11 states that we're focused on. So we think it's a big, big opportunity for us to go after. We're increasing the investment. We're putting more feet on the street. Those people are hired and literally started this week.
I mean, the U.S. accounts for about 30% of your sales, but I think sales were flat in 2025. What are you expecting 2026 to look like?
Yeah, I think it's important that even though sales were flat at a total portfolio, we had several brands. The brands were really focusing on actually growing. So we saw Aperol growing. We saw Espolòn Tequila growing, even in a tougher market. And so, as I announced at the Capital Markets Day, we've really looked at our portfolio and said we want to make fewer, bigger bets. And that's exactly what we're doing, putting all of our effort behind fewer brands and really driving it. So when you look at the total portfolio, it was flat. But if you look at the individual brands we're focusing on, we saw some very good growth.
How's your program of brand disposals going? I know you sold off, for example, Cinzano and Averna. Some of the sparkling wines business also went. What's next?
Yeah, I mean, I think we've looked at the portfolio. When I first came in, we had 72 brands within the portfolio, and not all of them have the same opportunity to grow as a brand like Aperol or Espolòn Tequila or Wild Turkey. And so we had to make the tough decision about really focusing the team behind the biggest bets. And as part of that process, we identified some brands that we just didn't think were playing quite the strategic role they were playing in the past. And as a result, we found some great homes for them, some great Italian companies that will love the brands and continue the great heritage. We're continuing conversations. I do want to be clear, we don't have to sell anything. The robustness of our business, certainly I think, it shows that. But where we see the right balance between the value we can achieve for it and the focus we can then put behind those bigger, fewer bets, that's really the balance we're working through.
Simon, I mean, you've been in the drinks business for quite some time. Have tastes changed? I know we ask this to a lot of the big, food companies because of GLP-1 and, things like Ozempic. Do we consume differently? I know you talked a little bit about it at the beginning, but do people want less sweet drinks?
Yeah, to be honest, it's one of the things that's exciting about this industry is the consumer trends are always evolving, and one of the things that we're doing at Campari is we're leading that. Our leadership within the spritz category plays across a range of different flavor profiles, from Sarti Rosa to Aperol to Campari to Cynar. So we have a whole range of flavors to go after. And what we're learning with this is consumers like to experiment. Whereas before, when I first started the industry, people would stay in one category. Now we're seeing a lot more experimentation. But the biggest thing is they're looking for that sociability, that opportunity to get together with their friends in an informal environment, and that's candidly what we do better than anyone else.
I mean, I spend, most of my days now talking about the price of oil and the fact that it could still jump 10, 15%. We really don't know what happens in the Middle East. Does that increase your cost significantly if it were to stay at that level? And can you pass on some of those price increases?
Yeah, I think, look, a lot of the commentators I've seen this morning have been talking about what if and how does this play out? And I think we need to be a bit balanced. We're 6 days in. So, yes, we've got to think around scenarios. For us, we've got 90% of our business is Europe and the Americas. And we have local production in many of those places. We have to make our cognac in Cognac. We make our aperitifs in Italy. So we're quite locally driven in terms of that. So I think the input would, or any kind of effect would really be on the input costs and on freight. On input, glass is a big user of energy. We'll have to see what happens. But as your previous commentator said, gas prices aren't anything near where they were back when the Ukraine situation kicked off. Mm-hmm. And then the second part is then on freight, particularly road freight. But at this stage, we're working through that. Our hope is that actually there's a peaceful resolution pretty soon.
You boosted your dividend significantly. You said you're also optimistic, your words, I think, on deleveraging going forward. Should we expect an increase in dividend in 2026?
Yeah, I think, look, we reviewed our leverage position, and the fact that we managed to get to 2.5 times a year earlier really shows the cash generation of the business. It's a very cash generative business. And so really pleased with our tight management of that to get us down to that. What we want to do is continue to delever. It then gives us the opportunity to either increase the dividend, either take the pause off our M&A side, or look at other opportunities of backing parts of the business that maybe need some more investment.
I mean, you've also said you're pausing bolt-on M&A. Why is that? And actually, if there was the opportunity of a lifetime, would you get back in?
Yeah, I think it depends what the opportunity of a lifetime is, to be totally honest with you. I mean, one of the big challenges we have as a team, well, then whenever I do that, the prices go up about 20%. So I've got to be a bit careful with that. I think, look, at the moment, what we're looking at is the opportunities we have within Campari are really compelling. We have a massive geographic expansion opportunity. We can break into new occasions with Aperol on tap and Aperol ready to drink, Campari spritz. So we've got a lot to focus on at the moment. And I think at the moment, we're not seeing anything outside that is that compelling. Now, I'm not saying never, and maybe there are some brands out there that will come around and we'll say maybe there is the one of a lifetime, then we can have a look at it. But the most important thing is by getting our leverage down, we have the optionality. We can then make the decision to either do that, or we can look at our dividend stream and see how we can further enhance total shareholder returns.
You've been in the top job at Campari for about 14 months. What surprised you the most since you joined?
I'd say probably two things. The first was the sheer scale of the opportunity. I'd worked with Campari, I'd admired the company from the outside, but we have so much opportunity that kind of the other companies don't have. So to post the great results that we put through 2025, in my view, we're just getting started with what we can do, even in a tricky environment. So that'd be the first thing. The second thing is, as you rightly said, I've been in this industry, I've worked in 5 different companies. The Camparista culture, our 5,000 Camparistas around the world, are some of the most passionate, determined, competitive team members I've ever worked with. And I think that was really shown through a tough year last year with some of the best execution I've ever seen.
Simon, thank you so much for joining us. Simon Hunt there, the Chief Executive Officer of Campari Group. Now, as we were saying, there's just a lot going on, especially in the Middle East. We understand from the state-run IRNA that Iran had sought something good in return to getting rid of the uranium stockpile. This was given there were U.S. talks in the last 2 weeks. And then we also heard from the state-run IRNA agency that the deputy minister was talking about extra hits possible in the next couple of days. Coming up, Greece's largest bank prepares to unveil its strategic plan for the next 4 years. We'll be speaking to Christos Megalou next. Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London, and these are your top stories. Iran says its retaliation against U.S. strikes will escalate over the coming days, while President Trump says America is doing, quote, very well on the war front. Tehran also vows revenge against Washington after a U.S. submarine torpedoes an Iranian warship by Sri Lanka's coast, bringing the war to India's doorstep. Plus, China tells its biggest oil refiners to halt diesel and gasoline exports as the country sets its lowest lowest growth target since 1991. So Piraeus Bank says it sees its dividend per share doubling by 2030 as it tries to diversify its revenue sources. In total, Greece's largest bank expects that it will distribute some 5 billion euros to shareholders over the 5 years to 2030. Well, with us is Christos Megalou, the chief executive of Piraeus Bank. So thank you so much for joining us. I mean, first of all, we look at the price of oil and shipping and everything, and it just seems that the situation in the Middle East is getting worse and is extremely volatile. What kind of impact do you see that on your business and on the Greek economy in general?
There is no doubt that things are becoming a lot more volatile the last few days. Oil prices are high, gas prices are high. Of course, nobody can predict how long this crisis will last, and hopefully we all hope for a quick resolution. But nevertheless, on the Greek economy in particular, what I want to point out, Francine, is that Greece has been many crises in the last few years, starting from the Eurozone debt crisis, and then going into COVID, and then, of course, the Ukraine crisis, which created some sort of similar to what we expect here, let's call it supply shock dynamics, and withstood the energy and other hikes. Yep. So I do expect that Greece in particular will continue to grow above European average over the next few years.
Yeah, I mean, can you talk to us a little about shipping finance? I mean, this is a speciality of Greece and Greek banks. Again, it's a very difficult time to know how you price a lot of these things, given what's happening in the Middle East.
That's correct. First of all, one interesting thing to look at, and very important, is if you are a bank and you are underwriting risk, your loan-to-value ratio. And I feel very comfortable with our book because our loan-to-value ratio on our shipping portfolio is below 50%. So that's a good place to be in and start. Obviously, when this crisis happened, rates are affected, so rates that our shippers are getting are much higher. Price of oil is also affected, so it is a mixed effect. However, if you are a lender and you are underwriting on a prudent basis, I think you are in a better shape to withstand the shock. So looking at our book and looking at the overall lending in shipping in particular, I would say I'm not that worried unless this thing is prolonged for a very long time.
Apart from your new insurance business, what else do you plan to do to diversify your revenue sources?
One very big focus for us is the wealth and asset management business. We have been growing this business significantly over the last few years, and our 5-year plan, which we are announcing today, is our Capital Markets Day in London, is basically focusing on a wealth and asset management fees for services and pickup significant, and of course our insurance business. These are the two drivers of growth. And then, of course, we have quite a lot that we are doing for the emerging Greek consumer. We have a new generation of people in Greece that are a lot more savvy and technically a lot more proficient in dealing with banks and systems. And for them, we are creating our new banking venture, which is Snappy. And we will be unrolling this over the next few years in Greece and beyond.
Christos, Euronext also recently acquired the Athens Stock Exchange. So the Greek stock markets operator, how does this affect your business, if at all?
I think is a very positive move, in my view, for the Athens Stock Exchange to become Euronext Athens. It will plug itself into the Euronext infrastructure. We have high hopes that this will create another cluster of business international for the Athens Stock Exchange, and having the opportunity to be part of the infrastructure of Euronext with all the regional exchanges will give us an opportunity on the investment banking business to be a lot more regional rather than just local. So I see it as a positive move. I expect also to help in the transition to the developed markets, and that's something that we're looking forward in Greece. We expect this to happen by mid of this year.
I mean, there's also potential upgrade of the Greek market to the developed markets by MSCI in late March. Would that have a significant impact?
Will have a significant impact, I believe, in terms of volumes. And already daily volumes in our stock is in the 80 to 100 million euros per day, which is unthinkable if you look at a few years back. I expect with the developed markets status ascension, this will follow even more.
Would you be open to some kind of merger with a foreign or non-Greek bank, or would you expect, or would you actually even welcome a foreign lender trying to get a stake in Piraeus?
Look, we are a management team that has delivered on results, and whatever we promised, we have delivered. We are today announcing our 5-year business plan, 2026-2030, with 10% EPS growth year on year, and a very significant uptick in dividends payments. So, of course, this will attract...
So you're not a takeover target, or are you? Could you be?
This will attract, I'm sure, investors, and we are here to create value for our shareholders. Our shareholders are very happy over the last few years. I believe they will be a lot happier in the 5 years to come.
Okay, so it's a yes or no, or maybe on foreign acquisition. Certainly something that maybe you wouldn't go looking for. Is that how I'm reading it?
We don't go looking for, but obviously we know that this is a very attractive proposition.
Okay, Christos Megalou, thank you so much for joining us today. That was, of course, the chief executive of Piraeus Bank. Now, David Solomon, the Goldman Sachs chief executive, says the initial market reaction to the Iran war has been relatively benign. He was speaking exclusively to Bloomberg at the bank's Australia Week event.
I don't see complacency. I think there's a lot of uncertainty around the direction of the conflict, how it'll be resolved, what the off-ramps are. And, I think it's fair to say when you look at markets, market reactions have been relatively benign. And I certainly could have seen over the last couple of days, a little bit more volatility. But I don't think people are being complacent. I think that market participants are looking and trying to say, how is this going to play out? What's the end game? You can see, good scenarios and more difficult scenarios. And as they have more information in the coming days, the coming week or two, I think that will have an impact on risk premiums. I think at the moment what market participants are really looking at is this going to translate through to things that affect economic growth and activity, particularly energy supply chains? So far, I think one of the reasons why markets are reacting the way they are is they're encouraged that there's strong support for trying to ensure that doesn't happen, but it's uncertain. You don't know, and we'll see. In the long run, for portfolio allocation, and I know Peter Oppenheimer, Sharmeen Mossavar-Ramari did a call for our wealth clients. If you have portfolio allocation, there's nobody that's saying you should change your fundamental portfolio allocation because of what's going on. But for traders and day-to-day market participants that think about risk premia, every single day, obviously they're watching very closely.
What about the people that run big, major global banks like yours, right? Do you worry about the lack of predictability when it comes to policy, when it comes to how this potentially ends and when it ends? What's going on with your Middle East operations, for example?
I worry about a lot of things. We run a big global business. We have an extraordinary team. And, I think one of the things that we have to accept is the world is a very complicated place. There's always a lot of uncertainty. There's always a lot of nuance. But we have, base beliefs on how economies will perform, how the world will evolve. And, we operate around that, but we always are prepared to risk manage and think about downside risks. And I think one of the things you have to do when you run a big, large financial institution is that when, facts change or risks come up, you've always got to be prepared to pivot, to shift, to de-risk. And, we run our business, that way always. We run a big balance sheet, and we think about that every day. But there's nothing, while these are very, very significant events, and I don't want to diminish them in any stretch, we've operated the firm through lots of very significant events year in, year out, and that's part of what we do.
Is it business as normal then for, say, your offices in Saudi Arabia? Is there still travel going on? What's the communication being with clients?
That is complex. We've got a significant number of people in those Middle East countries, and obviously, first and foremost, we're concerned with their safety, and we're trying to do everything we can to support them and their families. I would not say it's business as usual in those markets. All those markets for all businesses are operating work from home and stay safe as a first priority. And so we'll just have to watch closely, how things play out. And, we're very, very focused on making sure our people and their families are safe and sound. And at the moment, that's our primary focus in that part of the world.
Do you think there is a bit of an existential cloud over Dubai as a financial center now?
Well, I do think safety and security, matters. And I wouldn't say, I think it's a little bit premature to talk about existential clouds. But, if you're living and operating in a place and you didn't anticipate this, it's quite scary and it's quite unsettling. And so, as I said, our primary focus is on the safety and security of our people there. And we're working very hard to make sure that we're protecting them and their families.
Well, that was David Solomon, the Goldman Sachs chairman and chief executive, speaking exclusively to Bloomberg. Now, data centers appear to have become a target as we move into day 6 of Iran war. Drone strikes have damaged 3 facilities operated by Amazon in the UAE and Bahrain. The threat of multiple data centers coming under attack at once during wartime is forcing tech companies to rethink their strategy. So let's bring Bloomberg's technology editor, Olivia Solon. Olivia, thank you so much for joining us. I mean, this is something that we've, really been trying to follow because it exposes some of the new risks out there. Talk us through what has happened.
Right, so the Gulf region has about 200 data centers, and earlier this week, 3 of them were hit. All of them were Amazon Web Services data centers. Now, we don't know for sure, if they were targeted, but it sure looks like it could be. And the FARS news agency, Iranian news agency, did say that it was because of Amazon's work with the military. We haven't been able to confirm that. There were some disruptions in the region. Amazon, the sort of data centers are basically down, and Amazon's telling people to move their data to other regions. And we still don't know whether it's kind of they were a particular target. But what is clear is Amazon was one of the only big US companies in the region that had its own data centers. A lot of the others, like Google and Microsoft, they have a presence in the region, but they tend to operate through local partners. So they rent out space in other people's data centers. So they're slightly more under the radar.
So how much of the setback is it for the industry in the region?
I think it's a little bit early to say for sure, but, this is a region that is investing a huge amount in digital infrastructure. It's got billions going in to sort of support the AI boom in the region. And clearly, if we start to see data centers as a legitimate target in wartime, there are going to be these additional costs, security costs, insurance costs. Again, it's very early. I've been asking kind of all my sources in the industry, does this mean you're going to have drone jammers on the roof of data centers, or rugged roofs, or I mean, Israel has some of its data centers underground, but most of these things are enormous and very recognizable from satellite imagery. So it's quite difficult to see how you would protect them entirely.
Olivia, I mean, there are so many questions also in this, war about the AI and how AI is being used. Again, there's, talk about Claude, which is owned by Anthropic, being used to, for example, look at targets. What do we actually know about this?
Right. So I don't know exactly how Claude is being used by the US DOW, as we now call it. But what we do know is that AI is used for surveillance, for analysing images, for identifying targets. I mean, the line that Anthropic was trying to draw was that it shouldn't be used for fully autonomous weapons, but it's very, very useful in an age of drone warfare.
Yeah. I mean, this also comes, last week's big story, this also comes at a time where Anthropic's founders are fighting with the Trump administration about controlling basically some of what's going on with the data and some of the use of AI. What do we know about that?
So Anthropic has a couple of very small things. In the grand scheme of things, a few red lines.
Yeah.
One is it doesn't want to do mass surveillance of Americans, and the second one, it doesn't want to allow its technology to be used in fully autonomous weapons. The US government has pushed back against that and has started to make threats that they might designate Anthropic as a supply chain risk. And, that's a designation usually we reserve for adversary companies like kind of China's Huawei, for example. So at the moment, as we understand it, they've just reopened negotiations on that front after a sort of a toys out of the pram moment. Yeah. But it's a little worrying that, we have to rely on these enormous companies to sort of create the rules around how AI can be used in a military context, and then those are just being kind of trampled all over by the US government.
I mean, and again, legally or technically, could the US government just take it over if they deemed it possible, or is it just impossible to say? I mean, again, there's all these rumors that you don't really know where the buck stops.
Yeah, I mean, I think it'd be pretty difficult for Anthropic to stop the US government from using its technology how it wants to, but I don't know.
Yeah, no one does. You're wonderful. Olivia, thanks so much for joining us. Bloomberg's technology editor, Olivia Solo. Now, coming up, Iran vows revenge after the U.S. sinking of an Iranian frigate off the Sri Lankan coast. This is Bloomberg.
It's Jobs Day, and Bloomberg has the report under surveillance.
Labour market anxiety sky high.
Could a weak labour market report spook economists?
This Friday, Jonathan, Lisa, Anne-Marie, and Mike will bring you crucial data and expert analysis at terminal speed.
There actually are white-collar jobs right now. It's not just doom and gloom.
The narrowness of job gains has always been the question.
The stability is masking some fragility.
Let's pay attention.
The February Jobs Report, Friday on Bloomberg.
The conversations that matter, the insights you need. This is the Pulse, and I'm Francine Lacqua here in London. Now, Iran has vowed revenge on the U.S. after it sank an Iranian frigate off the Sri Lankan coast. Now, the sinking pushes the war towards India's doorstep, where Prime Minister Narendra Modi has sought to avoid taking a firm side. Well, I'm now joined by Dan Strumpf, Bloomberg senior South Asia reporter. Dan, thanks so much for joining us. So what does a sinking mean for India's involvement in the war? Will we expect Modi to respond?
So far what you've seen from the Indian government is a very measured response, really trying very hard to stick close to this sort of neutral line, not taking any particularly strong side on either stance of the war. One thing that's important to bear in mind is just in the days just leading up to this conflict, Prime Minister Narendra Modi was in Israel visiting with Benjamin Netanyahu and the Israeli government. Now, he has attracted quite a lot of domestic backlash for that visit, saying that it has given a sort of tacit approval to Israel for its strikes against Iran. The attack on the Iranian frigate off the Sri Lankan coast really ups the ante for the Prime Minister, as well as for this entire region, because this really does happen squarely in India's backyard and really does signal quite a vast expansion of the U.S. scope of this war beyond the Middle East, really in a sort of global sense. This did happen in international waters, but it happened in what's known as Sri Lanka's expanded economic zone, which is sort of an international law designation that does put it somewhat within sort of a territory that India and Sri Lanka see as part of within its sphere of influence. So the pressure is on for the Prime Minister to respond, but so far still quite a measured and neutral response.
Dan, could he just not respond? I mean, because he hasn't done so, or is he just biding for time?
I think there's a very good chance that the government will continue to sort of walk this very tight line, trying not to take a very hard position one way or another. There's a lot at stake for the Prime Minister, you have to remember. On the one hand, India does have long-standing and deep ties to Iran. It previously was a major buyer of Iranian oil. It's not anymore. But Iran and India do have long-standing ties. agriculturally, on trade, and in a number of other dimensions as well. Now, on the other hand, India is balancing quite a precarious relationship with the Trump administration right now. Just last year, it had been slapped with these 50% tariffs, were quite punitive, some of the highest in the world at the time. Just a few weeks ago, those tariffs came down, as we all know, and India recently struck a trade deal with the U.S. as well. And it has been on thin ice for a long time with the Trump administration, and very much does not want to risk angering Washington right now on this war. And at the same time, as I said, India is drawing closer to Israel as well. So it really has a lot of balls in the air at this point, and doesn't have much to gain by taking a particularly strong stance. But again, as I said, this conflict is slowly inching towards India in this very real way. And the Sri Lankan authorities have just said there's a second Iranian vessel in its waters right now. So, quite a lot of balls in the air in this region at the moment around this conflict.
Dan, thank you so much. Dan Strumpf there, Bloomberg senior South Asia reporter. Now, Iran is set to choose a new supreme leader as soon as possible, according to semi-official state media, as the war disrupts crude flows to key importers. Despite the conflict, Iranian military officials say the Strait of Hormuz remains open. Well, joining us from Dubai is Anthony Di Paola, Bloomberg's Middle East energy markets reporter. So thank you for joining us. Anthony, what's what do we know right now about the Strait of Hormuz, and can it remain open? Is it barely open? Like, what's the situation on the ground?
It's effectively closed, we would say, perhaps barely open in the sense that there are some Iranian-linked tankers that have made it through, some bulk carriers that have made it through, but it's a trickle since this started on Saturday. So really that waterway is effectively closed, and that's really choked off a lot of the vital oil trade that is supposed to come out of this region. These tankers, some tankers that have loaded in the Gulf and were on their way out, are stuck in there. They can't get out. And then we have a bunch of tankers that are idling just outside the Strait of Hormuz on the Indian Ocean side that are waiting and trying to get in there to pick up cargoes. If these vessels can't get in to pick up that oil, this is going to create a problem for the producers there, because we've got refiners that are turning crude oil into gasoline, diesel, and jet fuel, and they're waiting to ship that out. If they can't and their tanks fill up, they're going to have to slow down the refinery operations there. If the refinery operations slow down and the companies can't ship the crude oil or refine it, then they're going to have to shut in some production. So we've already seen Iraq shutting in some production, taking more than 1 million barrels at least offline, expected to rise higher. So these are the kind of issues that we are seeing. And that's on the oil side, not to mention natural gas. We've seen Qatar even declare force majeure on their main LNG exports there. So they've halted those completely, which is really unprecedented. So we're seeing a lot of these difficulties with really knock-on effects for the markets, and that's got prices skyrocketing, particularly for gas, up pretty healthily for oil as well, Francine.
Anthony, I mean, Washington has proposed this plan to provide insurance guarantees to vessels and possibly naval escorts. I mean, would that really make a difference? And how feasible is it?
Well, we are waiting to hear more details about that from the administration, also from shippers and from oil companies who are also waiting to hear those details. So, we are talking to people in the market and trying to figure out what they are hearing about that, whether this would be something that would be worthwhile. So far, we're getting a lot of skepticism from the market, from the ship owners, because it's simply dangerous to pass through there. So even if there is insurance, that would not alleviate the issue of danger. Part of the skepticism around the insurance is that organization that Trump has indicated isn't really designed for that kind of insurance issuance, and they have even a smaller availability of funds compared with the need of money that they would need for the insurance. Then on top of that, there's the security issue. Just if we look at the issue around the Red Sea and the Bab el-Mandeb, when we saw that shipping was under attack by the Houthis from Yemen, there were escorts there, and they were only really able to escort a fraction of the ships going through there, really only able to stop attacks on a portion. So it's going to be even more difficult in this kind of narrow strait with a big adversary like Iran threatening there in Hormuz, Francine.
Anthony, thanks so much. Anthony DiPaolo there, Bloomberg's Middle East energy markets reporter. Now, Bloomberg's Michael McKee also has an exclusive interview with the Richmond Fed President Tom Barkin. Catch that at 1:30 p.m. London time. Up next, Bloomberg Brief.